My name is Richard Green. I'm director of the USC Lusk Center for Real Estate, and it is my very distinct pleasure this morning to welcome home, if only virtually, Raphael Bostic, the president and CEO of the Federal Reserve Bank of Atlanta. As many of you know, Raphael was on our faculty at USC for the neighborhood of 20 years. We were colleagues together at USC for 10 years. And if I could share just one story, is I was very honored when he came to me in 2009 to ask whether he should go for the job of Assistant Secretary for Policy Development and Research at HUD. And I said, of course you should do it, because it would be good for the country if you did it. And having served at PD&R after he left, I can tell you from his legacy that I was correct, that his presence there made the country a better place, because he improved the body of evidence that is available to make decisions about things like housing and mortgage finance policy. So again, a great pleasure to have Raphael back with us, wearing a very sharp shirt, I should note, by the way. And so let me start with a question that involves fiscal policy, and the Federal Reserve is about monetary policy, and we're certainly going to get into that. But it has to do with forecasting what the economy is going to do in the second quarter. And it's about an issue that I'm a little confused about. So when I see forecasts of the second quarter of GDP, it's calling for fall of 30 to 40% on an annualized basis, or if you look at the consensus estimates. But that's annualized. So for the quarter, that's 7.5% to 10% of the economy, which is about $2 trillion, something less than $2 trillion. And we've seen this stimulus program roll out whose various elements add up to now nearly $3 trillion. We think that the multiplier effect on this is about 0.6, so that's like 1.8 trillion. So how do we take all of that into consideration in thinking about the amount of money that's going to be available in people's pockets to spend in the second quarter of 2020?
Well, Richard, before I answer that question, I just want to say good morning to everyone. It's good to see you. It's good to be back at the USC family. And, most of you have been to USC events. There's plenty of bling going around. So it's a good opportunity to show some of it off for a group that would appreciate it. When you think about the fiscal response, I have to say that it has been significant and substantial. And, one of the things that I think has been perhaps overlooked is really how fast this has happened and how bipartisan the approach has been. The House is voting remotely on these things, and they're getting basic unanimous passage. In the Great Recession, the first bill, the TARP bill, failed. So this is really a different time, and I think it's a testament to the appreciation that everybody has that we're in a different type of emergency, and one that everybody can truly understand. The other thing I would say is that the relief that's going out is extremely broad-based, and it's my hope that it's getting to businesses and the families in a way and in a timeliness that helps them bridge some of the difficulties. There's a lot of uncertainty about how long this is going to last. We've never actually seen, and certainly not in my lifetime and not for a long time, something that's been so widespread in terms of its impact. We are all living this together. And so unlike a hurricane or an earthquake, where there may be a market or a geography that's hit, this is the whole country. And so the scale is totally different. And we're going to have to figure out, and we'll learn sort of what's necessary and appropriate. But what's been done thus far is substantial. And my team is continuing to keep an eye out to see if there are areas or pockets where relief is not getting to.
So let me ask specifically about one aspect of the fiscal stimulus, then we'll move on to monetary policy. But unemployment benefits have been raised substantially, an extra $600 a week. How does that flow through the economy more broadly? Does it mean that people are going to be able to pay their bills better than they would, well, clearly better than they would in the absence of it, but how different is that going to look relative to where we were 3 months ago, particularly in light of the fact that there are a lot of people who formerly weren't eligible for unemployment insurance who now are?
Yeah, so that's a hard question to answer specifically. What I would say is this, the unemployment insurance is a way to touch people that we know are actually being disrupted and hurt. And it's in a direct way. And it's quite different than the economic impact payment, that $1,200 a person with a child credit. That's a different kind of relief. And I think it actually makes a big difference and will make a big difference because the folks who file for that insurance are really looking at a situation where they're not going to have any income, and they know that for sure. And so it's going to certainly allow them to pay back their bills and cover their bills and expenses in a much better way. I think the question, and we've heard a lot of concerns about the size of the support that is really around what does that mean, the existence of this support mean for people being willing to get back into the labor market? Because in many markets, I'm in the Southeast, there's a lower cost market, and there are a lot of jobs for which the support appears to be greater than what the market rates are for wages. Part of the concern there and the issue there will be how long this goes and how long we are in a more shut down environment. But it's something we're going to watch, but it definitely matters. And I would say that one of the things that we are really trying to get a sense of is, to what extent this relief is helping families. And one thing I should emphasize, we know that about 40 to 45% of families don't really have any kind of savings, right? And so they didn't have a buffer to fall back on. So if they don't have income, they're really not going to be able to spend on anything. And so this is a really big change for that.
So let's move on now to what you're involved with, which is monetary policy and regulation of financial institutions. The Fed has opened up a number of credit facilities in order to help with liquidity issues, particularly we have a lot of businesses out there that we know are good businesses, but just don't have cash flow at the moment. Could you tell us about 3 of the most important facilities and how they work?
Well, I think they're all super important.
Okay.
We have 9. I think we've rolled out 9 facilities in about a 6 to 8 week period, which is unprecedented. And one thing I do want to emphasize is that this is bold, and the board and the committee has acted in a very decisive way to get support and relief out there. I think for me, the ones that are the most important and significant to start were the ones that dealt with the financial markets. So thinking about primary dealers and a liquidity facility for them, which allowed us to make sure that we can continue to execute monetary policy.
And excuse me, Raphael, but for our audience, could you please say what primary dealers do?
Sure. So the way monetary policy works, we set a rate for lending, and that market is a very small market and it's a very specific market. And there are just a couple of financial institutions that participate in that. They're called primary dealers. And so they are the vehicle by which a lot of that short-term lending happens, that then becomes the way that we transmit monetary policy through to the banking system and then to the broader economy. So that's super important there. I would also say that, we provided, let me call out one that's a little more obscure, which is the facility on dollar swaps. This has been an important thing for other central banks around the world because so many international contracts are done in dollars. And so we wanted to make sure there was stability in those markets. And let me just step back and say, all the facilities that we've put out have been in response to signs that particular markets were breaking down, whether it be the treasury market, whether it be the corporate debt market, whether it be the municipal market. In all these places, we are starting to see spreads widen to historic levels that called into question whether those markets could make. And so if we have all corporations not being able to issue debt to raise capital, that then is going to put stress on their lines of credit, which then puts stress on banks. And so we want to make sure that there aren't these breakdowns in the various ways that capital and credit is allocated. And so we've responded in all of those ways. And then I know folks are really interested in the pivot that we've made to try to do facilities for Main Street as well, for businesses. We provided extra liquidity for the Paycheck Protection Program. And we've also, we've announced and we're working on the Main Street Lending Facility, which is really designed to reach out and touch businesses above that SBA limit of 500 employees or less, so that we're trying to make sure that there's support and relief that gets to virtually all segments of the marketplace.
So let's move on to something that I know you care a lot about, have been working on your entire career, which is the mortgage market. And there are some issues now surrounding that market. First of all, spreads are very wide between 10-year treasuries and 30-year fixed rate mortgage rates, about 90 basis points wider than usual. And we're finding people who could still benefit from refinancing even at these elevated rates relative to treasuries are having a difficult time getting that refinancing. Could you comment on some things, some policies that might be implemented to deal with these issues?
So, the mortgage market has been an interesting one because it's being touched in a number of different ways. So through the CARES Act, there's a lot of forbearance that was put out there that was offered to families, and that has direct implications on the basic functioning of the mortgage market and the liquidity that's going to be provided. What I would say is the signs I've seen are that some of the concerns that people have had about the mortgage market have been sort of attenuated to some extent because of policy responses around the GSEs in terms of what they're requiring of mortgage servicers. The Federal Reserve continues to buy a significant number of securities to try to make sure there's liquidity in the market. And there's one aspect that I think has been, I've been particularly sensitive to, which is just the ability to do transactions because of clerks in local governments. And if these governments are shut down, then we can't actually record the things that need to be recorded to close these. And it's triggered a series of responses by local governments to try to figure out how to digitize, how to automate, how to create attestations and the like about values and the things such that transactions can continue to move. So it's actually been really interesting. And we've seen this across the board about how this shutdown and this inability for people to come together, really creating some interesting innovation and adaptation in how we're going to get things done. And the mortgage market has been no exception to that.
So I'm curious, in your part of the world, do you have any sense of how many transactions are being interrupted just for the simple reasons that you gave, the inability to do attestation, the ability, the absence of clerks, et cetera? I know you don't have a specific number, but do you sense that this is a large share of transactions, a medium share, small share?
So I would say it's probably medium to small, but it is geographically varied. So in big cities where there's a mature infrastructure, I think many of those cities have, if they weren't already moving to a more remote ability to do transactions, they've figured out how to accelerate that. But if you go to more sort of the outlying suburban
Oops, Raphael, yeah.
But if you go to some of the more outlying or suburban areas, I think you start to, or rural areas, those are the places where I think you're going to see a much larger impact moving forward.
So I want to come back a little bit to servicing issues, which you sort of touched on briefly. How worried are you about the capacity of servicers to deal with the forbearance issues? And again, what policies do you think might be appropriate? Or maybe you're not worried and don't think needs to be a policy response?
Well, I mean, you can be sure that I've heard a lot from people who have called me about the servicing issue. And this has been something that has definitely been at the forefront of my thinking about where we are. I actually have a pretty significant and robust research team that works on housing. And so they started yelling at me about this as well. What I would say is that the policymakers in Washington are paying attention. And what I've heard and from them is that they're monitoring the marketplace, and if there are signs the stresses are starting to emerge that are larger than what they expected, that they'll act. And I think we've seen this in the case of Fannie Mae and Freddie Mac. They initially were not doing very much in terms of forbearance. They've announced movements there with the sign off from the FHFA commissioner. And we're going to continue to watch. And if we see those stresses evolving, we're going to reach out and engage. So I know, Richard, we were talking earlier, there is still some divergence between how Fannie and Freddie are treating these. My expectation is, and my hope is that they talk to each other, figure out what makes the most sense. They talk to a lot of servicers and find a way to make sure that that small clauses or small variations don't trigger large impacts into the marketplace. Just one last thing on this. Before the announcement on Fannie and Freddie, we were starting to see evidence that mortgage lenders were pulling back from certain types of markets. Here in California, jumbo market spreads were starting to widen pretty significantly. And there was a risk that this was going to bleed into the single family purchase market in a pretty significant way beyond just refinance, but just as a basic servicing, and it was going to be new construction as well. We've seen a lot of reduction in tension in that, and I think that's a very good thing.
So on reduction in tensions, I'm going to ask you one last question before I move along to the large number of questions that I'm seeing in our Q&A function. So the Atlanta Fed has a forecast, and what everybody wants to know is U or V or L, and part of it is a reflection of all the stuff that we're throwing at this problem that we have right now, to use an understated word. How much will it help keep the plumbing of the economy intact, which means that we recover faster? So what is the view of the Atlanta Fed on this at the moment?
Well, I would say there are diversity of views in my building. I'll tell you sort of my view,
okay.
Which is it really depends. So here's the backdrop, right? The day before the virus came here and we had to move to social distancing protocols, the economy had been growing for basically 11 years. The fundamentals were sound. We had historic levels of unemployment, and the basic plumbing of the economy, as you say, Richard, was in pretty good shape. So the whole idea, in my mind, to the policies of relief that have come forward, and people call it stimulus. I actually look at it much more in terms of relief, have really been to try to preserve as many of those fundamentals as possible, so that when we get to the other side of this, those fundamentals can click back on, and we can get to a recovery that starts to look the way the economy did before. So we're monitoring right now to see how much to what extent this relief is providing those sorts of bridges and preserving that stability. Just important to remember, the PPP money is relatively new to the economy. The checks, the economic impact payments, many of those went through direct deposit that our bank actually manages, but a bunch of them are going to go in checks that people still have not yet gotten. So there's still a lot of relief to go through, and we're going to start to see, I think, in the next 3 to 4 weeks, get a much better picture of what that's meant in terms of preserving stability. But it's a definite source of concern. I talk to small businesses a lot, and what they've told me is that they're going to do everything they can to hold on, and they're very hopeful that that this relief gives them enough so they can move forward. But we're still in the early stages of knowing exactly what's going to happen.
So I'm gonna ask you one more question, because I've seen you answer it before, so I think I know how you're going to answer it. So you're talking about to the other side. When do you think the other side comes?
So this is a good question. It's the hard part to forecast on this is that it really depends on how the virus's spread progresses. If the virus's spread progresses in a way such that we get it under control quickly, then I think the ability for us to get into that robust, stable recovery period comes much sooner. If, on the other hand, we're in a situation where we don't have the virus's spread controlled, The confidence of consumers is not going to be there to do a lot of the things that would typically happen in the basic economy. And so it's going to take longer for that recovery to happen, and it will happen in a more slow way. So it's important at this very foundation to remember that this is a public health crisis at its heart. And because of that, the recovery is going to really depend on how well we do in dealing with that crisis.
So let me turn it over to audience questions. And again, because I have a lot of them, I'm going to combine some of them. And just as I did a week ago with another speaker, I'm going to do my best to try to cover everybody's questions, but it may be that yours gets put in with somebody else's. So let me start with a real estate question again, but on the commercial side. What do you see about forbearance of loans for commercial properties? How widespread do you think it will be? And one of the things about forbearance is once we're through this period, how do we expect people to repay what they didn't pay earlier?
So in terms of forbearance, I think the initial focus has been definitely on homeowners and households and families for many. What I would say in terms of commercial properties, I think is going to be a case-by-case based situation. But in terms of the repayment, I would just let you know that as we've been putting our facilities together, one issue that has come up repeatedly is that don't create a bridge and then have it such that the repayment terms become things that are not manageable. Because if we get them to the other side and then drop a heavy weight on them, then we've just defeated the basic purpose. So we've been thinking very hard internally about how long and what the terms of those repayments are. And as I've talked to bankers who are restructuring the loans for their customers, they're having that conversation. When I talk to multifamily property owners, for example, they are also starting to have those conversations in terms of what's the proper appropriate scoping. So it's definitely in the forefront of people's minds, and I would encourage all of you as you talk with your lenders, or even you talk with folks at the Lusk Center, if there are some optimal term structures that you think should be pursued, I would definitely think there'd be value in having that conversation and trying to get ideas out into the domain.
So let me follow that up with the landlord-tenant relationship on forbearance. And so we know lots of landlords are forbearing with tenants. Part of the reason is because they see it as good business practice. Part of the reason is they're being told that they can't evict anyway in many jurisdictions. But again, and we see this on both the commercial and the residential side. So for example, owners of shopping centers are forbearing with many of their tenants because their tenants are closed. They have no cash flow. But again, when we open up, if you just say to people at that point, now you got to pay all your back rent, well, that will almost certainly lead to a default, whether it be on the residential or the commercial side. So do you have any thoughts on how that might be best handled, or are you talking to people about that issue?
Well, we're definitely talking to people about that. Richard, one other thing I would say in terms of landlords is that the current environment, forbearance makes sense because if you kick someone out, you've got to find someone.
Exactly.
And in today's environment, who are you going to get that's going to be in a better position, that you're going to know better or have any greater likelihood of getting repaid? So I think there are lots of reasons why we want to forbear. I think that this is going to really be around having conversations between tenants and landlords. I think what I found in my conversations with landlords is that they all understand that the challenges that their tenants are having are not because they've taken undue risks. The nature of this is quite different. And I've really heard a willingness to extend the relationship and the nature of what that repayment looks like. I would also encourage landlords and property owners to talk to their lenders as well. We at the Federal Reserve have really encouraged banking institutions to work with their borrowers and their customers to try to reduce the amount of burden that their relationships with their customers are. I think that this is going to be a time where there's a real opportunity for everyone to come together and find sensible solutions to a crisis that is really not of any of our making, but rather has been dropped upon us. So So there's a lot of talking that needs to happen, a lot of engagement. I've actually not found anyone who has said, I'm just going to hold everyone exactly to their terms. I've not heard anyone say that. And so part of the important thing is to talk about it and have a conversation and really ask people.
So I'm going to again combine a number of questions on this one, but inflation is something that a number of our viewers are raising as an issue. And of course, the Federal Reserve is, appropriately in my view, printing a lot of money right now. What is the Fed's outlook on inflation as a result of all of this? Is it something we need to be concerned about?
So we've been concerned about inflation. We've been having concerns about inflation spiraling out of control to the upside for the better part of 7 years. And it just hasn't been realized. And there are lots of technical reasons and explanations for why people think that is. But I would say right now, I don't think the spiraling inflation is top of mind for me as a concern. And in fact, there are a number of reasons why we might expect there to be downward pressure on prices in the current environment. The oil situation remains significant. The introduction of technology is reducing the cost of doing a lot of business. And these are structural things that were already going on that in some sectors and some markets are actually accelerating. And so I'm actually not that worried about inflation now. I don't think we're going to really have this an issue for the next 6 to 12 months. But if it starts to feel like it's going out of control, I have every confidence that the committee will pay attention and will respond as necessary.
So along those lines, I'm curious, how much coordination is happening between the Federal Reserve and other central banks around the world? Because the entire world is dealing with this crisis right now. Is there any kind of coordinated monetary policy response, or are you guys just sort of keeping up to date with each other about what you're doing?
Well, we always interact, and we have a regular ongoing relationship with all the central banks. I wouldn't say that there is direct coordination such that we say, okay, we're going to act on Wednesday, you guys are going to go on Thursday. But we definitely make sure that our central banking partners around the world know sort of how we're thinking about things, know the issues and the concerns that we're seeing. It's actually very interesting. In this role, I've had the pleasure of and the opportunity to speak in Asia and in Europe. And in both those instances, they pay pretty close attention to what's going on in the US. And so the things that we do actually will help inform the decision that policymakers will make overseas and vice versa. So I think I won't want to say we coordinate so explicitly like we all get in a room and then decide, but we are very closely engaging with them, and we'll continue to do so. And we want to make sure that the global economy gets through this as well as possible, because we are part of that economy. And if there are weaknesses in other places, then that has the potential to come back and make it tougher for us.
So this question I'm going to attribute to our joint friend, Michael Banner. Michael asked the question, if unemployment will be bad around the country, which it is, how bad do you believe unemployment will rise in urban areas inhabited by people of color and lower incomes? So what is the distributional impact of all of this?
Let me say two things on this. First, we know the numbers for last month and this month are going to be tough. They're going to be rough. But the question for me is really, to what extent are they permanent job losses versus temporary job losses? And this really gets to the question of relief. So if the relief gets to businesses in ways that are helpful and can keep them having a relationship with their workers, then it's my hope that many of these job losses that are being recorded now will actually not be what the story is when we think about the COVID response over the enduring term. Now, in terms of impact on communities, we actually know that before the crisis, there was a differential reality in terms of certain neighborhoods and certain segments of our population being able to participate in labor markets and in entrepreneurship and all those sorts of things, with ethnic minorities and poor people definitely being at a disadvantage. there's a real concern that this crisis, just like many other crises, will hit these communities harder. They are less resilient. They have fewer savings. The relief that they're going to need is going to be more acute and in depth. The businesses that support them will also not have the same levels of resilience. And so it's an important issue. So I was on a call yesterday with enterprise community partners where we talked a lot about this. The role of philanthropy is going to be important. The role of community development financial institutions and other financial intermediaries is going to be important. And thinking about what kind of structural things and policy are barriers to support here as well. So it's something that we're definitely concerned about. My team is now doing, actually we're doing a survey every 4 to 6 weeks of institutions and nonprofits that work in low and moderate income communities. And I think we just released the results of a study yesterday or the day before that I would encourage Michael and others to go look at, because there's a lot of information there and there are real stresses.
So, an important contributor to local economic activities are state and local governments. School systems, for example, are often the largest employers in a community. They're going to be in trouble because their tax revenues are going to fall. And I know the Fed has a facility for municipal debt, but if you could comment a little more on policy response to the issues that state and local governments are facing at the moment.
Well, let me say, you remind me of just one thing, which is that, with all these facilities, we are issuing them with the support of the U.S. Treasury. Right, so there are some legal authorities that we have through the Dodd-Frank Act, the financial reform of 2008 or 2010, whatever the year was there, that give us the emergency authority to issue facilities, but they require Treasury backstop. Right, so we have constraints, and we are a lender, not a spender. Right, so we do loans, we don't do direct grants. So when you think about the governments, state and local governments, they are definitely in stress. That's one of the reasons why the municipal facility was stood up, because we recognize that is going to be a considerable issue. The open question is, and this is another thing, we've never done a municipal facility, so we're learning as we go. But also the federal government needs to be monitoring local governments to see if the relief that's out there is enough. And if it's not, they're going to have to make decisions about whether some more direct supports are going to be needed. This is not something that we really have the authority to act unilaterally on. And so we will monitor and inform policymakers of what we see, and then we'll take their lead in deciding what our next steps will look like.
So a couple of people have brought up the issue of affordable housing development, that there's been contraction in tax credit pricing and willingness of banks to quote new deals. This is happening at the same time governments are pulling projects forward to stimulate. How would you respond to that? As you worry about that affordable housing projects are going to be slowed down as a result of this, and what could be done in response to that?
So, that's an interesting question. On one hand, in many places in my district, for example, construction is being deemed basically as an essential occupation, and so housing and other things can be built and can continue to be built. I think the question really is about moving forward. If you have businesses that have significant losses, how do things like tax credits work, and how do you continue to get stimulus into or incentives that matter into that infrastructure? I think these are hard questions, but these are questions that we also had coming out of the Great Recession, and we frankly don't have straightforward answers for this. I've been talking with folks here in local government to really start to wrestle with a bunch of these sorts of questions about, should cities start thinking about affordable housing bond financing in an era when the cost of debt is low. Those are the sorts of conversations that we're going to continue to have. But this is I think it's a frontline issue and a frontline concern as more families are potentially at risk of needing housing that is lower cost than what they're in right now.
So I'm going to ask a question that perhaps you don't want to answer, and that's fine, but it's from a former student of yours, and that's why I'm going to ask it. It's from Daniel Farasat, and it says, he was in your class at the time Lehman Brothers crashed.
Yeah, I
and
remember
he said,
that.
yeah, and he said everything you were about to teach doesn't apply anymore at that time. And he says it seems like a new rule book is being created again, and people are saying don't fight the Fed. Who will be the biggest winners of the Fed's actions is his question.
Well, I hope the answer to that question is the American people, because what we are trying to do is make sure that that this exogenous shock to the economy doesn't wreck just millions and millions of lives. And so we need to make sure that businesses stay as stable as possible. We need to make sure that households are able to continue to bridge this. And that's my first and foremost focus. And also that people stay healthy, that we do things in a way that allows people to keep their health, because this is a health crisis, and if we don't get that right, it's hard to see how the other stuff is going to really work out. So I actually think much more broadly about sort of the broad foundation of support that our facilities and our actions more broadly have been designed to accomplish. And so this is very different than the Great Recession, where there were clear risks that emerged in particular sectors that needed to sort of work themselves out and be resolved. This again, we were not seeing signs of elevated risk taking in any sectors really, and we had been looking pretty hard for the better part of 3-4 years. So for me, I think the winners hopefully will be everybody, and we get things to people in time and in ways that can help them move forward.
Well, that sort of touches on a point that a couple of questionnaires have made is how much do you worry about moral hazard, that people are just going to take undue advantage of the programs that are out there right now? And I guess my follow-up to that is, is that so second order, we shouldn't even be worried about it at all?
Well, when in doing any kind of policy, you have two choices. You can either be fast or you can be precise, right? But if you're going to be precise, that means that you're going to have to set up a bunch of conditions. You're going to have a lot of monitoring that's required. You're going to have ongoing attestations and all that kind of stuff. And I think that in this instance, because of the speed at which economies were shut down, policymakers made a decision that they needed to be fast. And that comes with costs for sure. And I think you've seen in the Paycheck Protection Program, there's been sort of almost like a public shaming of public companies that have taken money from that program when it's clear that they had other ways to raise capital and had flexibilities that perhaps some other companies and small businesses did not. And we're starting to see people turn that money back. And so yeah, there are always problems. Nothing is ever going to be 100% perfect. But in this instance, I think it was really important to signal that we're going to get relief out there as much as possible, as broadly as possible, and do it in a fast way. So my hope is that as we see the difficulties and some of the ways that individuals and institutions might be taking advantage of things, that if we get to a second or a third wave, we start to see responses and reactions that can kind of limit that moving forward.
Question from Denise Keys. It seems like the U.S. does not have emergency or triage infrastructure in place for economic emergencies such as this. What would it take to have an economic ER, and who would best implement this system?
So that's an interesting question. I'll say this. I don't think any playbook of how you manage a company or how you manage a government or an institution envisioned this kind of disruption, right? So we are truly in an unprecedented time, and we thought that the stress tests we were doing coming out of the Great Recession were rough, This is a whole nother level in terms of the type of disruption that we're looking at. And so I think it's going to create a conversation that starts to look at some of these things and really raise questions about, when you drive a sector or market to a very high level of efficiency, uh, you can see huge shifts in productive capacity because of relatively small shocks. And we've seen this in terms of going to the grocery store and not seeing paper towels and toilet paper because the amount and the supply chains for household use of those goods is so separated from the supply chain for commercial uses for those goods. I think it's going to lead to rethinking about all of those sorts of things. And we may actually see a collective willingness to have something and an approach that doesn't continually push us completely to the knife edge of the last marginal dollar being deployed so ruthlessly. So I think this is a question that's an open one. I think it's a very interesting one. And I'm really looking forward to seeing how we all respond to this and sort of where we settle.
So I am going to say we have a bunch of questions asking you to forecast short-term interest rates, and I know you really shouldn't do that, so I'm not going to. I just want to acknowledge to people who ask the question that I see it, but
this is okay. This is just my opinion.
All right. Okay.
We're basically close to zero. I don't see our policy rate shifting in a significant way unless we see signs that the economy is truly back on its feet. And the forecast that I've seen about sort of what that looks like, that's 3 months, 6 months, 12 months out, depending on circumstance and local context. So we're going to continue to watch. I think the chairman was pretty clear that we are not in a hurry to jump back into a more restrictive stance. We want to make sure that we don't act proactively. And I think it's important that we don't act prematurely and cut off some of the momentum about a recovery that we really need to see happen in as strong a way as possible.
So let's finish up with a philosophical question, and the reason from Joseph Jonathan, and the reason I love the question is that it dovetails with one of my favorite Keynes quotes, which is, "When the facts change, I change my mind." What has happened during this crisis that has made you rethink previously held assumptions?
Oh, so that's an interesting question. I don't know that that it's changed, but what I would say is this. Before this crisis, the Federal Reserve was not supposed to get into municipal funding. It wasn't supposed to think about really providing support for corporate debt. The notion that you would give a lump sum payment to every household, but meeting a certain income level, something like a minimum income threshold, these were all things that were in the idea space, but not necessarily in the reality space. And I think what I've learned, perhaps again, is that when hard things happen, when very unexpected things happen, everything is possible. And we've definitely demonstrated that in how we've acted. And I think the Congress has done that as well. So the commitment of our country to collectively try to come together to help and provide support has been demonstrated in a way that maybe some cynics of the political things that have happened in the last several years might have thought would not be possible. There's an American spirit that's still there, and there's a collective America, the notion of America that's still there. And I think that that we need to take this moment and remember this and try as much as we can to keep it in how we approach ourselves and our businesses and our neighbors.
So, Raphael Bostic, CEO of the Federal Reserve Bank of Atlanta, thank you very much for joining us this morning. I'm going to share my screen now so folks can see how people can reach out to the Atlanta Fed. There's at atlantafed.com, and I also know there's another page.
Here.
What?
Definitely connect with us at Atlanta Fed. I also have a Twitter feed. It's just at Raphael Bostic. Feel free to follow me there as well.
So text 33777 to get the Atlanta Fed weekly newsletter. And they do great work there. I have good friends who do work I follow very closely at the Fed, at the Atlanta Fed. They do great work on housing economics in particular. So you're going to want to follow them. Again, Raphael Bostic, thank you so much for joining us this morning.
It's been a pleasure, Richard. Very good to see you.
Good to see you too. Fight on.